Hey everybody, Luke Gromen, FFTT. Hope you are well, having a great week. It's a beautiful week here in Cleveland, and this week is my wife's birthday, so we're getting ready to celebrate that as well. So let's jump right into the questions, and as always, thank you very much for submitting them. Really appreciate it. First question is from WB. I think this forward guidance discussion was extremely relevant. It'd be great to hear your thoughts on China's balance sheet recession, where the U.S. might be, is there one in certain sectors, and what current Chinese deflation does to your inflation bounce back views. China clearly growth slowing or slow. They are clearly having some issues in certain areas. Couple things within it that I do not see a lot of discussion in Western financial media about China's slowdown and economic difficulties. The first, noting that China can actually have sustained slowdown and even some outright deflation for a period of time without an outright collapse of their financial system. That's not how it worked here. Once we got into deflation, you saw the authorities spring into action pretty quickly. So that's noteworthy to me on one level. The other thing I think that is really noteworthy is that I continue to see very little ink being spilled about why China's doing this. If everybody knows that growth is good and deflation is bad, why are they doing this? Presumably they're not stupid. So what's the bigger strategy here? We know the Chinese tend to not do anything without a bigger strategy. They don't just kind of go from bubble to bubble every 2-year election year cycle like we do. So why are they doing this? And I don't know for sure, but I think there's a couple things. I think number one, I think China has their eye on a much longer time horizon in terms of what they're trying to accomplish here with this whole eat bitterness. They're trying to essentially grow their way out a little bit more slowly, trying to, I think, establish or continue to win credibility that has been hard-won credibility for yuan-denominated commodities, etc., for their system and for their bond market. As much as we see in the Western media that the Chinese stock market has done terrible and massively underperformed the S&P, and it has, their bond market, 10-year Treasury or 10-year Chinese government bond yields are still nearly 200 basis points below 10-year U.S. Treasuries. They've been doing a very good job supporting their bond market, a less good job than we have. So that's one thing. The other angle that I think probably deserves more consideration than it gets in the West is why else might China be doing this? Ultimately, are they engaging in a pain contest? In other words, running things slowly and seeing who cries uncle first, the U.S. or China. And if that's the case, seems possible to a 50 basis point cut today and 50 basis point cuts more coming, that perhaps it's the U.S. that's crying uncle first. So let's see. That to me is not, it's not a high conviction area. In terms of what it implies for inflation bounce back, ultimately, anytime Chinese growth isn't high enough, global growth isn't high enough. Anytime global growth isn't high enough, U.S. growth isn't going to be high enough. And anytime U.S. growth is not high enough, U.S. debt to GDP is going to get much worse, much faster, and bring the U.S. fiscal problems we've been highlighting ad nauseum forward much more aggressively and necessitate Fed rate cuts, U.S. stimulus, etc. So, to me, some version of that cocktail I just laid out is the game that's afoot. So let's keep an eye on it. From Chris, gold to oil ratio spent much of the last 100 years in a range of 10 barrels per ounce to 30 barrels per ounce. You've talked about how going forward, that ratio is likely to rise since the oil market is, call it 12 to 15 times the gold market. I agree, but what could make us wrong and keep gold oil tethered in or near that 10 to 30 barrels per ounce band? To me, the big thing that would change it would be a shift back to the unipolar world of 1990 through 2014 or 2018, depending on how you want to define it. If the U.S. energy, dominance became extremely dominant, we became, 80% plus of global oil production. I don't think that's going to happen, but it's possible, I suppose. When you talk about shifting back to unipolar, what we're really talking about is Russia stopping selling oil outside the dollar and China stopping buying oil outside the dollar. Short of coups or economic collapses of both of those countries' leadership structures, I find that highly unlikely. Alternatively, if you had a massive drop in the share of oil of total energy BTUs expended, we make some sort of big shift to fusion or perhaps to nuclear or what have you, maybe that would work too. But as long as progress keeps being made on multi-currency oil pricing, and as long as oil's share of BTUs expended remains relatively steady, I think we're probably going to continue to see the gold to oil ratio rise over time. From Ryan, what would a viable AI or robot VAT, value-added tax, look like in your view? What would be the political game theory around a policy? I guess a little background is important first. So we've talked about needing a productivity miracle as a way out of the debt problems, but I've also talked about that it needs to arrive in Goldilocks-like fashion. In other words, not too fast or not too slow. Arrives too slow, it's not going to be in time. Arrives too fast, drives too much unemployment and creates more problems than it solves. So how can you use tax policy on AI and robots in theory to offset that? In theory, yes. What might that look like? I don't know. You could do some sort of GPU, tax on AI semiconductors or on robots that goes into a fund that then invests in the technology and other job retraining, things like that. Conceptually, something like that might work, but from an execution standpoint, that requires a level of wisdom and foresight that, to be blunt, is sorely lacking across most of the Western politicians I see, certainly, especially given the money involved. So I think it's much more likely that we get large disruption to employment markets from AI and robotics at some point, and then you get politicians trying to do UBI on the back end, universal basic income on the back end for displaced workers. So, let's see. From Matt, what's your mental framework for thinking about the timelines for wage deflation from tech advancement, AI and robotics, paralleled with that of accelerating monetary debasement? Lots of variables, lots of unknown variables. Love to hear your thoughts. So it's a great question. I think it's really important on this issue. Lots of unknown unknowns, as Rumsfeld famously said 20 years ago. But if we start from a first principle that I think governs this whole dynamic, which is deflation is fundamentally incompatible with our debt-based monetary system. Deflation will blow it up. Mathematical certainty. So if we start there and then work backward, then you can kind of say, okay, what are we watching for? Let's watch the progress on AI. Let's watch the progress on robotics. Looking for headlines on that, looking for economic data on it, looking for tax receipt data. I've seen or heard reported that some of the higher ups in AI development are very concerned about the 2026-2027 time horizon. Maybe, I don't know. We watch that time horizon. We watch to see their actions. We watch to see if that time horizon gets pushed out. In terms of being a tipping point where AI and robotics start to non-linearly put downward pressure on wages. That's what that moment in time would represent. So, to your point, it depends on a lot of different variables, a lot of which are unknown, and so it's going to be very tricky to get exactly right. And I would recommend the average investor play this the way I personally am playing this, which is I'm not trying to get cute and time it. I don't know when it's happening. I can see the trend. I'm watching for big changes in the trend or big accelerations in the trend. If I don't see a reversal, the trend's going to keep going, and at some point it's going to accelerate. I don't need to know when exactly that happens if I'm not levered. So stay unlevered, and ultimately in a debt-based system, once we know that first principle, deflation is fundamentally incompatible, then it just becomes a matter of time if we're unlevered until central banks have to start more fully reserving sovereign debt. More fully reserving means growing their balance sheet to prevent the nominal default of Western sovereign debt that serves as collateral for everything else. Ultimately, that's really good for Bitcoin. That's really good for gold. It's really good for industrial stocks, equities more broadly. So unlevered, though, because timing this is going to be extremely difficult, very best case. From Tom, how can the debt crisis be resolved without causing a depression, default, war, or currency debasement? So there is an example in history of that being able to be done via productivity miracle, and it was in the post-Napoleonic Wars in the UK. High levels of debt coming away from the Napoleonic Wars, and the productivity miracles were pretty much unprecedented in human history up until that point. You had the Industrial Revolution. You had the discovery and then rapid commercialization of fossil fuels. You had transportation technology that was unprecedented, moving from buggies and carriage, horse and buggy, to trains, steam-powered ships, cars, planes. And then all of these things arrived really neither too slow nor too fast. You also had the English, not appreciate, this isn't appreciated, repeal the Corn Laws and effectively set up the first attempt or the first go-around of globalization and neoliberal free trade, where the British essentially offshored their working class jobs to lower cost countries around the empire. It created problems. It contributed to Dickensian wealth inequality, but no debt default and no depression per se, certainly not for the merchant classes, and no currency debasement. So it can be done. It's extremely tricky and requires massive productivity increases that, to be blunt, don't happen that frequently in history, and in this case has to happen at just the right speed because the debt's so high. So hopefully that gives some frame of reference for how I'm thinking about it. From VX, hi Luke, what are your thoughts on oil dipping below 70? Doomberg makes a very good case regarding the abundant oil and gas supply in the U.S., and his thesis seems to be playing out. Does that affect your thesis about the dollar and in U.S. Treasuries, and how? I agree oil is abundant. I agree gas is abundant. Let's see. Oil so far has not stayed below 70 for very long. I've been told by multiple former high-level energy execs that shale production will not stay at current levels if oil goes too far below, call it 65 or 60. So is it possible it goes into the 60s? Sure. Is it going to last there long? Probably not. But that'll be our test. Let's say Doomberg's right, and let's say oil goes to 50. It's not, the case is not oil can't go to 50. The case is oil can't go to 50 and shale keep growing. And so if we get oil to 50 and shale keeps growing, I'm going to be wrong. Full stop. What I would suspect would happen is if oil went to 60 or 55 or 50, is all of a sudden you're going to see rig count in the U.S. start to fall sharply. And then you're going to start to see shale production roll over. And the nature of shale, which declines at a 6% per month rate, at a declining rate, you can see what we saw in 2020, which was shale production fell sharply when they laid rigs down and didn't come back to 2019 levels until 2023. So again, you get oil down low enough that it starts laying down shale rigs and shale production rolls. What that means geopolitically is you are going to cede the oil market globally to the Russians and the Saudis for the next 2 to 3 years, maybe the next 4 years. That's a non-starter for the U.S., in my opinion. So I think the wild card in all this is you get oil to 65, and I think you're going to get Harris or Biden or Trump saying, hey, we're going to refill the SPR, baby, and bid it right back up to 70, because I think that's the level it needs to be at. So let's watch and see. From Michael, I would like to better understand how increasing global international reserves of gold will affect the ability of the U.S. to run a perpetual $1 trillion trade deficit. Say if we return to a 1980 balance with 60% of the global international reserves being in gold, 20% is the dollar. Ultimately, the mechanics will negatively affect the U.S.'s ability to run deficits without tears. They can still run deficits, but it's going to show up in the value of the dollar. In other words, we want to run $1 trillion, and really it's not $1 trillion deficits in perpetuity anymore, it's $2 trillion in perpetuity. So we want to run $2 trillion deficits in perpetuity. We're either going to need to force our banks to buy it or our investors to buy it, which will crowd out and slow growth and make the deficit worse. Or the Fed's going to have to print money either directly or via proxy with U.S. banks, SLR exemptions, etc., and basically print the money and finance the deficit themselves de facto, which should weaken the dollar, increase inflation, which would serve to weaken the deficit or to lower the deficit over time. So it would higher percentages of gold reserves would ultimately force the U.S. to print the money to finance entitlements and defense and interest, or else cut one or more of those items. And finally, from Ben, how high would the PE on the S&P 500 have to go for you to view the 10-year Treasury at 3.6% as a better store of value than stocks over the next 10 years? The S&P 500 de facto backs the Treasury market. So it's a little bit of a chicken and the egg question. So remember, net capital gains plus taxable IRA distributions alone are 200% of the growth in U.S. consumer spending, which is 2/3 of GDP. So if stocks don't go up, U.S. GDP can't go up. U.S. consumer spending can't go up mathematically, and GDP probably won't go up. And if stocks fall, you're going to see weak GDP and you're going to see weak consumer spending, and that's a problem because you're going to see Treasury supplies up with the bigger deficit from the recession. And that's what I mean. The S&P de facto backs the Treasury market. So ultimately, I would have to see the PE on the S&P a lot higher before I would start thinking that the Treasury, 10-year Treasury at 3.6% was a better value. As long as debt to GDP is this high and deficit to GDP this high, the U.S. needs the S&P to rise by 10 to 15% plus every year just to keep the fiscal situation from really falling apart, which is how the S&P de facto backs the Treasury market. So if you got the S&P high enough, that receipts rose enough, that issuance fell enough, Treasury issuance fell enough, that debt to GDP and deficit to GDP were far lower, then that discussion would change in regards to all those things. But the S&P would have to be much, much higher than here before that would begin to drive deficit and debt down much lower. So that's it for today. As always, thank you very much for joining me. If you like these updates, check out FFTT-LLC.com for more information about our Tree Rings product. 10 most interesting things, brief synopsis on what grabbed our attention, how it's changing how we were thinking about the world or confirming how we were thinking about the world. And as always, thank you very much for joining me. Really appreciate it. Look forward to chatting with you soon. Take care, everybody.